Your money is in the account. The balance is visible. The numbers are there, but access is a permission. And permissions can change. If ownership is absolute, why does access depend on compliance? If deposits are safe, why can withdrawals be paused? If the system is stable, why are emergency powers written into its foundation? Access feels permanent. It is not. This is not about forgotten passwords or isolated technical failures. It is about how modern banking systems are designed around conditional liquidity. In a debt-based monetary structure, access to funds depends not only on your balance, but on institutional solvency, regulatory compliance, and systemic stability. The architecture of modern finance prioritizes continuity of the system before continuity of individual access. To understand this, it is necessary to begin with a simple but rarely examined truth. A bank deposit is not stored property. It is a liability. When you deposit money, the bank records it as an obligation it owes you. The funds are not placed in a segregated vault, labeled with your name. They are pooled with other deposits and used to fund loans, purchase securities, and support leverage. Under normal conditions, this distinction is invisible. Under stress, it becomes decisive. Banks operate on fractional reserves. They hold a portion of deposits as liquid assets and lend out the remainder. This model allows credit expansion, which supports economic growth. It also creates structural dependence on depositor confidence. If too many depositors demand cash simultaneously, liquidity strains. Liquidity strain does not necessarily mean insolvency, it means timing pressure. To prevent cascading withdrawals, banking systems incorporate mechanisms designed to pause or limit access when necessary. These mechanisms are rarely discussed during periods of calm. They exist nonetheless. Throughout monetary history, access has been restricted long before currency collapsed. In 1933, during the American banking crisis, the government declared a national bank holiday. Banks closed temporarily. Withdrawals were halted. The goal was to prevent panic and stabilize the system. The deposits did not disappear, but access did. In 2001, Argentina imposed withdrawal limits during a sovereign debt crisis. Citizens could not freely withdraw their own funds. Capital controls were introduced to prevent capital flight. Accounts remained on paper. Liquidity was rationed. More recently, during the 2013 crisis in Cyprus, large depositors experienced bail-ins. Portions of uninsured deposits were converted into equity to recapitalize failing banks. The legal framework enabling this action was established before the crisis. Few depositors examined it. Access, again, was conditional. These examples are often dismissed as extreme cases in unstable economies. But the mechanisms behind them are not unique to any one country. Modern banking regulation across many advanced economies now includes bail-in provisions. Instead of relying exclusively on taxpayer-funded bailouts, creditors and certain depositors can be required to absorb losses. The language is technical. The implication is structural. Deposits above insured thresholds are unsecured claims. Insurance thresholds vary by jurisdiction. Amounts beyond those limits carry risk exposure to institutional solvency. The illusion of total safety persists because crises are infrequent. But infrequency does not eliminate design. The mechanism gap widens here. How can access be limited in a digitized, highly advanced financial system without visible collapse? Because money is now primarily digital. Cash represents a small fraction of total money supply. Most transactions occur through electronic payment networks. These networks rely on centralized clearing systems. Banks monitor transactions for compliance with anti-money laundering regulations, sanctions enforcement, and fraud detection protocols. These systems operate continuously. If an account triggers a compliance alert, access can be frozen pending review. The freeze may last hours, days, or longer. The funds remain on the ledger, but the user cannot transact. The decision is administrative. The appeal process is procedural. Time becomes leverage. Access delayed is access denied in practice. In stable periods, these controls are rarely noticed. In periods of heightened regulatory scrutiny or geopolitical tension, monitoring intensifies. Intensified monitoring increases the probability of temporary restrictions. Restrictions are justified as safeguards. Safeguards protect systemic integrity. Systemic integrity may conflict with individual immediacy. This asymmetry is subtle but real. Institutions act first to contain perceived risk. Individuals are informed afterward. Consider liquidity facilities operated by central banks. During financial stress, central banks inject liquidity into banking systems. These facilities ensure that banks can meet short-term obligations even when markets tighten. Support flows to institutions directly. Households benefit indirectly. If liquidity stress intensifies rapidly, authorities may impose withdrawal limits preemptively to prevent disorderly outflows. The goal is stabilization. The effect is restriction. This does not require systemic collapse. It requires precaution. Precautionary restriction redefines access as conditional. Digital payment platforms deepen centralization. As societies move away from cash toward electronic transactions, access depends on network connectivity, account standing, and institutional authorization. Cash in hand is autonomous. Digital balances are mediated. Mediation introduces gatekeepers. Gatekeepers operate according to regulatory frameworks and institutional incentives. Institutional incentives prioritize solvency and compliance. Individual liquidity is secondary. The consequence gap begins to form. If access is increasingly mediated and conditional, what happens during periods of economic stress? In high-debt environments, banks rely on stable deposit bases to fund loans. Sudden withdrawals force asset sales. Asset sales reduce prices. Lower asset prices weaken balance sheets. To avoid this spiral, restrictions may be imposed before panic spreads. Prevention often requires limiting freedom temporarily. Temporary measures can extend longer than expected. Monetary systems evolve to manage fragility quietly. Fragility accumulates through rising leverage. Global debt levels have expanded significantly over recent decades. Sovereign debt, corporate debt, and household debt all increased relative to economic output. Higher debt means higher sensitivity to liquidity disruptions. Liquidity disruptions are mitigated through policy tools. Policy tools include access management. Access management can be targeted or broad. Targeted freezes may affect specific accounts flagged for compliance issues. Broad measures may apply to entire banking systems during crises. Both rely on structural authority embedded in banking law and regulation. The authority is not hidden. It is rarely contemplated by the public. Credit lines illustrate another layer of conditionality. Banks can reduce credit limits or close accounts under risk reassessment clauses. These actions do not remove deposits but constrain liquidity. Liquidity constraint alters behavior. Behavioral changes feed economic activity. Economic activity influences systemic stability. The architecture is interdependent. When institutions face uncertainty, they prioritize capital preservation. Capital preservation may involve tightening access to credit or scrutinizing transactions more aggressively. From the institutional perspective, this is prudent risk management. From the individual perspective, it feels abrupt. Institutional asymmetry is inherent. Institutions possess aggregated data, liquidity buffers, and regulatory coordination. Individuals possess contractual claims. Contracts include clauses permitting suspension under certain conditions. These clauses are standard. Few read them carefully. The right to restrict exists long before it is exercised. The illusion of permanence is sustained by routine stability. When stability falters, latent mechanisms activate. The activation does not require conspiracy. It requires stress. Stress may arise from sovereign debt pressures, banking losses, geopolitical sanctions, or currency volatility. Sanctions regimes demonstrate how access can be revoked without insolvency. Banks are obligated to freeze assets associated with sanctioned entities. These obligations can extend to individuals and corporations. Compliance is mandatory. Access can vanish instantly. Most assume such measures apply only to distant conflicts or extreme circumstances, but the infrastructure enabling them is universal. As digital identity systems integrate more tightly with financial services, account access becomes linked to broader compliance frameworks. Know Your Customer protocols, transaction monitoring, and reporting requirements expand continuously. The rationale is security. Security centralizes authority. Centralized authority enhances control. Control reduces spontaneity. Reduced spontaneity increases predictability. Predictability stabilizes leveraged systems. Leverage underpins modern economies. Without leverage, growth slows. Slower growth increases political pressure. Pressure prompts intervention. Intervention often involves liquidity management. liquidity management may involve access constraints. The cycle is subtle. Access is not guaranteed because deposits are part of a dynamic system balancing solvency, liquidity, and compliance. The final resolution of the mechanism gap lies here. Your deposit is a claim within a leveraged institution operating under regulatory authority in a debt-saturated economy. That claim is honored as long as honoring it does not destabilize the system. If honoring all claims simultaneously threatens stability, prioritization occurs. Prioritization may involve delay. Delay may feel like denial. The consequence gap resolves quietly. As financial systems become more digitized and more indebted, the capacity to manage liquidity through access control increases. Capacity shapes policy options. Policy options shape behavior. Behavior reinforces structural hierarchy. This recognition is not an alarm. It is a clarification. Access has always been conditional in banking systems. The conditions were simply less visible in earlier eras. Physical cash allowed partial independence. Digital systems eliminate that buffer. Ownership now depends on permission to transact. Permission depends on institutional continuity. Institutional continuity depends on systemic stability. Systemic stability depends on leverage management. Leverage management depends on control mechanisms. Control mechanisms include the ability to restrict access. Most of the time, they are dormant. Dormancy creates confidence. Confidence sustains participation. Participation funds leverage. Leverage increases fragility. Fragility necessitates readiness. Readiness requires tools. The tools exist. They are legal. They are procedural. They are rarely discussed. Access is maintained through trust. Trust persists until it is tested. When tested, priorities become visible. And when priorities become visible, the meaning of ownership changes. Not dramatically, not loudly, but structurally. Access is not guaranteed. It is administered. And administration follows incentives embedded long before the first restriction is ever applied.